Let's talk about Japan and how that could impact the parallels between Japan and the U.S. The Nikkei has fallen in the 90s. It took them 2 decades for the previous all-time high to be reached. Are you saying that's going to happen in the U.S.?
So Japan has different demographic problems, right? And so they were rebuilt after World War II. They were figuring things out, but their birth rate declined. So I'm saying the same thing is going to happen in the U.S. It's just going to take a lot longer, depending. Mm-hmm. So if this $6 trillion stuff from Joe Biden comes through, and then if you raise taxes to pay for that versus printing money, you just now the government becomes such a larger portion of GDP, which makes you more permanently inefficient. The greatest year of GDP growth was during the Great Depression, when they spent a massive amount of stimulus, but you permanently made I believe it was 1936 or 1937 where you had 10 or 11% GDP growth. But at that point, the government, it becomes such a large share of GDP, it crowds out the private sector. So the bigger the government is, the more efficient and more productive the private sector has to be. And so if the private sector is, say, 90% of the pie and it grows at 4%, well, then you're going to have somewhere along the lines of 3.4, 3.5 GDP growth. If that private sector is growing at 4 or 5%, but it's only half of the overall economy, how much can the overall economy grow? So I think Japan, it happened a little bit quicker than it's going to happen here. But I hear too often people talking about hyperinflation and all these things that are going to happen. It's a long way away for the U.S. Our national debt is about 30 trillion. Our household assets and balance sheet is about 130 trillion. Japan, that ratio is like a 1-to-1. So for us to get there, it's not that we can't get there. It's just going to take us longer. Does that make sense?
Yeah. So in the interim, then, before we get there, you're still bullish on the stock market, correct?
Yes. So a lot of good factors going on for the stock market right now. So this money printing will inflate stocks. It makes multiples higher. It allows larger financial institutions to allocate more capital to risk assets. Okay, you combine that with this earnings season. So as of last night, we were tracking at 44% earnings growth. Okay, granted, last year was a bad year, but the analyst estimate going in this quarter on December 31st was for 16% earnings growth. So we are at 3 times analyst estimates. Now, let me tell you, in the history of analyst estimates, okay, there's maybe 1 or 2 occasions where they were too bearish, not too bullish. How analysts work is they sit there in December, and they make their forward year projections. Those numbers are always too high, and they come down as the year goes on. Okay, we are now in a situation where analysts are off by a factor of 2 to 3. Nothing like this has ever happened before. So this snapback and this recovery in the U.S. economy especially has been much more substantial than even the wildest bull like myself could have predicted. I think multiples look high, but they're actually lower because earnings are going to be much higher than even the rosiest of expectations because of the combination of fiscal stimulus. And the fact of the matter is, as President Donald J. Trump changed the way business is done, he cut the corporate tax rate from 35 to 21. He made it much easier to produce things here. It was the largest deregulatory event in the history of our country. And as a result, we have snapped right back. So we are chugging along. If the Biden administration wanted to do something good for the economy, they'd sit on their hands.
Okay. Now, Michael, excellent point about stimulus causing the assets to inflate. Now, the key of what you said that I discerned was that you think earnings are actually going to improve, because one common counter argument to your bullish thesis from other economists spoken to is that, yes, monetary stimulus has caused the stock market to inflate, but that's just a bubble because the fundamentals of the company are still weak. Their earnings are still weak. They're not generating pre-COVID cash flows. Is that argument correct?
So, maybe, but you have to look at the backdrop, right? And so now we are also at the beginning stages of business cycle. At the beginning stages of a business cycle, okay, as times are going to get better for the next 2 or 3 or maybe even up to 5 years, that multiples tend to expand. Okay. And as things are getting better, you enter a bull market, and then towards the end, you start having the bankruptcies, and then those multiples go ahead and collapse. And you have that going for you. In addition to that, you have the Fed buying $80 billion worth of treasuries a month, $40 billion in mortgages. That's a lot of liquidity in the system. It's like $1.3 trillion a year into the system. And then you have earnings. And now earnings may not be as good as pre-pandemic, okay? But again, it's earnings relative to your overall macro backdrop, right? And interest rates. So interest rates are zero, the economy is getting better, and earnings are much better by a factor of 2 to 3 than analyst estimates. So as you enter that sort of situation, you're going to see yourself get to multiples and valuations you may have never seen before, right? Because it's not just if a company earns $10 a share, how do you value that? In a bull market, that could be a $200 stock. In a bear market, that could be a $50 stock, right? Mm-hmm. It's how you value that multiple. And I say what the most important thing that most people don't talk about is that those earnings matter against a factor of other things, right? And if a company's earning $10 a share and they were expected to earn $20, well, that's terrible. But if they earn $10 and they were expected to earn 6 or 7, well, that's amazing. And so we are in that latter scenario now to a degree that's never, ever, ever been seen before.
Wow. Sector-wise, what are your preferred sectors?
Yeah, so this goes back to the inflation play. I prefer technology. Okay, in the first quarter, it was a rough quarter for technology as the 30-year got hammered, right? And as and value really outperformed. Okay, I think that was a head fake. There was a number of one-time events that happened that pushed the 30-year treasury lower. And as soon as the quarter ended, that stopped and technology resumed leadership. If we're in a low growth, low inflation world kind of permanently, as far as the eye can see, you really want to own these companies that are growing revenue at 20 or 30% and growing their earnings at 20 or 30%. Okay. If we're going to have 3 or 4% inflation, and you could sell a can of Coke that sells for $1 today is going to sell for $2 in 5 years. Why wouldn't you pay? Why do you want to pay a 40 multiple for the growing company when you could pay a 10 multiple for the value company to get an inflation jump? So we're seeing that reversal right now. So my favorite sector, XLK, technology, big cap tech stocks, right? Second favorite sector is XLC, the communications sector. That is your Facebook and Google. Those companies have more power than the United States government. They run the world. They dominate online advertising agency. That's where that's going. And then consumer discretionary, which we saw with Amazon last night.
Okay. Do you like gold, Michael? Because given your outlook on inflation, which is not very high inflation, I would presume if you assume that gold is an inflation hedge, I would presume that you don't like gold very much as an investment, but I could be wrong. How would you address this?
So, look, I am definitely not a gold bug, but I don't believe we're going to have real inflation for a while. Like at some point it's coming, but it may not come. But I own physical gold, and I think everybody should own some physical gold. And if you believe in a lot, if you think I'm wrong about inflation, then you want to own a lot of it. If you think I'm right about inflation, you still want to own some. I mean, if there's a zombie apocalypse, you're going to need your gold, right? So like there is no scenario where you don't want to have some physical gold, right? I view the ETFs and the gold miners and that sort of stuff. Those are trading vehicles, not necessarily investments. So if you own GLD or GDX, those are trades. Right. So if you see gold sell off hard, you want to buy that for a 10 or 20% pop to the upside. So I would not own those as a core portion of a liquid asset portfolio. I would, however, own some physical gold based on your viewpoint of inflation. I think everybody should have some physical gold in their home, in a safe, or wherever they can access it should the proverbial hit the fan.
It does strike me as interesting that you think that we're in a situation similar to Japan. I remember speaking to some Japanese people who lived through that time. They had deflation during the 90s, and so under that environment, you don't actually need an inflation hedge. If you put your yen or dollars or whatever currency under your mattress, actually you're gaining value year over year. So, are you saying we don't need an inflation hedge anymore for the foreseeable future? Is that your play?
No. Well, look. So for the U.S. to have massive inflation, something needs to take its place. Okay, and I can tell you with all the financial troubles that we have right now, it's much worse in Europe. Okay, and then China is 10 times worse, and the Chinese currency and economy are an absolute house of cards. So if the U.S. dollar is going to devalue, what's it going to devalue against, right? So Japan had to compete with the U.S. dollar, right? And the pound and the Swiss franc and the German Deutschmark and then the euro. So now it's as bad as we have it, everybody has it that bad, right? When I say we're not going to have inflation, I think inflation is going to tend towards 1% to 2%. We're not going to get much higher. And if we have some readings of 3 or 4% this year, it's transitory. I don't know that we'll have the deflationary scenario that Japan does now. Right? We talk to me in 10 years, and, depending on how the next decade goes, but that's what the model for us is like you're talking about it. I just think it takes longer and happens slower. Does that make sense?
Yeah, absolutely. It makes sense. Mike, I want to thank you so much for speaking to Kitco today. It was your first time. I'd be happy to have you back. Excellent thoughts. Thank you. Thank
you very much.
And where can people learn more about your work, Mike?
Hey, michaelleestrategy.com. And I'm on Twitter at Mike Lee Strategy.
Excellent. And if you're watching this, don't forget to subscribe on YouTube. I'm David Lin. Stay tuned for more coverage at Kitco.